Hello and welcome to Future Proof. I'm Padraig Floyd, and today I'm talking to Lizzy Holliday, Director of Public Affairs and Policy at Now Pensions. Lizzy, thank you for joining me again. And first, can I start off with getting your views on any concerns or reservations you've got about the government driving forward with both investment reform and consolidation at the same time?
Yes, no, that's a very specific and very interesting question. So, in the context of the DC consolidation consultation and also the government's wish for schemes to invest in private markets and to be doing more of that and to be doing that quite quickly, I think there's a slight challenge potentially. I mean, obviously, caveated with that we don't have the final outcome of that consultation paper yet. But when you're kind of thinking about needing to potentially be seeing a lot of scheme mergers and acquisitions in order to achieve the scale requirements, which I think the consultation paper talked about a minimum of 25 billion to 50 billion assets under management. What you're looking at potentially is a lot of movement in the market. It does depend on the detail, depends on the definition of what counts as a single default, whether it has to be a single default, whether that figure applies to the default fund or to the provider. But you can imagine a situation where if you're thinking about investing in private markets, it's a very long term undertaking and it can be quite fiddly and potentially expensive if you make an investment in private markets and want to come back out of it within a short term period of time. So I think there's a slight challenge there in terms of not yet having the detail, but moving towards consolidation. And it was proposed over a 5 year period. And 5 years isn't really that long for private market investment. So I think it's a challenge, and one I think, I'm hoping that government will be mindful of when they come to think about how they're going to take these measures forward.
Well, one of those details and also challenges concerns the pipeline of appropriate investments, doesn't it? And are you convinced or reassured by what the government said so far that they're going to be able to they're going to be capable of providing that pipeline of suitable investments?
So yeah, I mean it's difficult, isn't it? Because I think there's been a couple of positive moves from government in terms of the broader strategy and their strategic approach to things like the National Wealth Fund and the infrastructure strategy, all the measures they're taking around planning, which will enable delivery of infrastructure, and it's really encouraging to see those things. I guess there's still an element of needing to see a bit more of the detail around how those things will develop and evolve and how that will translate into creating a pipeline that's really appropriate for pension fund investment, which is, an appropriate risk and reward profile, and also kind of an appropriate, back to a timing point again, but an appropriate kind of lead in time for visibility of those things, because obviously there's always going to be the challenge of where government is, and depending how they do it again, so depending on whether it's mandation, depending on whether it's just encouragement, I think incentives are probably not necessarily on the table. So if it looks at mandation or a really strong encouragement to a very particular deadline and to a very particular target, I think that brings all kinds of challenges around if the pipeline isn't there or it's not sufficient for the amount of demand on that pipeline, then pricing could become an issue. So if you have like a huge raft of assets all driving, or investors all driving to want to make investments in the same kind of things, and it's all very public, it's going to make pricing, I think, a little bit of a challenge going forward. So I would say sort of encouraged by activity, but I think there's a little way to go yet to see, and we want to get there. We don't want to wait until the proof of the pudding's in the eating. We need to have a little bit more notice than that. So really keen to see a bit more detail on that from government.
Look, I wanted to ask you some questions specifically about now. Of how you go about doing things. You raised some interesting points in the session you did at the PLSA with Border to Coast and HMRC. Could you briefly describe or explain your three R's, your kind of fundamentals of framework of risk, return, and real world impact, and how they actually interact?
Yes, absolutely. So the three R's, which I think is a really handy way of describing it, which I stole from a colleague, so our director of investment, Martin James. So he calls the three R's. And what this is about is it's trying to articulate that those three things all have to be right. So getting the risk and the return right and also the real world impact is quite important for our trustees. I think sometimes there can be sort of a bit of a slightly different take on these things, and people might sort of challenge and say, but your first responsibility is to your members, so that's just about return and reward. And we would sort of say, well, actually, you don't have to sacrifice the return and getting the right risk and return balance in order to have real world impact. You can actually, in this instance, have your cake and eat it. You can do all three, and we do all three. So we have sort of quite a full sustainability agenda, and we're quite keen to focus on those real world impacts. But that does not mean that we're sacrificing returns for our members. Our trustees are quite ruthless at looking through these things and looking into the detail and understanding the really significant impacts in the real world, but also on the returns. And so you can set something up that gives you the returns that you're after for the right risk profile, but which also has real world impact.
Okay, but tell us more about those sustainability principles then, and how they may be influenced or affected by any encouragement or mandation, perhaps, that may be further down the line from what's happening with government policy now.
Yeah, absolutely. I think in terms of our statement of investment principles, we talk about three core things. So one is responsible investment. So that's everything that kind of looks at environmental, social, and governance factors, as well as the real world sustainability. There's then an element of stewardship, which is about using your voting power, and that's about encouraging the companies in which you invest to address any issues like sustainability risks, but also making progress towards our sustainability themes. And we have three of those as well. We've got lots of threes. So we have three sustainability themes, and they're living wage, gender equality, and climate action. And then we have a raft of other elements as well around climate crisis and climate action. So those are kind of like our core principles. Obviously, they sit alongside other investment principles, but on this topic, those are the core three principles. And they're all kind of integral to the investment process. And I think they all kind of speak into the fact this pensions are a long-term investment, and our trustees are long-term investors, and our savers are long-term investors. And so these are principles which mitigate risk and enhance returns, and they're mitigating against the risk of climate change as well. They're helping other companies make that transition process. So this is all about the long term, and it's all in our members' best long-term interest. In terms of whether or not there's sort of challenges because of government's appetite for investment and where it's looking for investment, I think in this space, I don't necessarily see any contradiction. I think you can achieve some of those private market investments. You can achieve investments into some of the areas they're looking at that also hit these principles. I think there's kind of some great synergies in terms of what government's after, as well as what the trustees are looking for. I think probably one of the helpful things that I've heard from the current government is that they do have a broader perspective on this than, say, for example, the Mansion House Compact of last year or the year before, whenever it was, which I think, although it kind of had the call out box was sort of quite high level and quite general, it was after a much more specific type of asset base. I think where we are with the current government, everything I've heard from them about their focuses kind of feels like there's a great synergy. So there is an opportunity to be had here, I think, about addressing a number of different objectives, but making sure that our trustee decisions are paramount in that process.
So it is possible then to balance fiduciary duty with those broader societal decisions that you may be making at the fund level.
Yes, yes, and I think it's about, I guess, the balance of those factors. I think what we don't want to get into is saying that the societal impacts kind of overtake the need to look at the risk and return. So it's about balancing those things together.
You mentioned scale earlier on. There is that rule of thumb that people are suggesting is between 25 and 50 billion. There was some interesting research that came out about a year ago, I think it was, that suggested that there's potential for diminishing the law of diminishing returns to kick in as well once you have scale. So, how would you define scale from your point of view? And I don't mind if that's with your now or PLSA hat on. And how relevant is, say, assets under management as a benchmark for such a metric?
Yes, this is an interesting one, isn't it? I think in my head, rather annoyingly, when I think about scale, I want to intuitively dig into what is the scale trying to achieve and like come at it from that angle. So, not intentionally avoiding the question, but I think thinking about what is it that we're trying to achieve from scale. And I think the government consultation paper was clear in some of those respects. So I think in particular they talked about access to private markets, and they talked about negotiation on price in private markets, and in a looser way, perhaps a less qualified way or less quantified way, they talked about efficiency. So there's probably a lot to unpack under those things, and it probably doesn't necessarily lead itself to the sort of very raw scale of assets under management measure. Um, I think that there's a kind of an additional challenge for government, which is the ease of regulation as well, which I think plays a big factor in where they might be going with this. But I think if you're looking at the underlying objectives you're trying to achieve, then access to private markets, well, we're accessing private markets and we're at sort of just under 6 billion assets under management. So access hasn't been a problem for us. I think they also talked about negotiation on price. I think that could lead you to think about assets under management, but perhaps at a provider level. It's unlikely a provider will be sort of negotiating on price just to buy into something for one default. They're going to be looking across the range of their products and the range of their funds. And then I guess there's something as well the government talked about in terms of capability within schemes to invest in private markets. And also thinking, I think some people approach this in terms of thinking about how much assets under management do you need to have your own in-house investment team. And what I'd say on that one is I know there's lots of different shapes and guises for that, but I would say in some business models, such as now pensions, the scheme sits within a broader business group, which has its own investment specialists and specialists in private markets. And so that capability isn't necessarily gained only through scale in terms of assets under management. It can be achieved through the group structure. So you can get that capability regardless of assets under management in a particular fund through your group capability. So I guess, I think the measure of scale could range quite considerably when you take into account the different business models that are out there and the different ways of achieving what this scale is aiming to achieve. I think in terms of efficiencies, I think the one gap we kind of saw in the consultation paper was there wasn't much discussion over efficiencies that are gained through the number of members within the scheme. And this is quite core to some business models that are out there, including now pensions. So we have over 2 million members. We have a certain approach to how we manage our efficiencies, and we can develop a business model, or we have successfully developed a business model that is delivered over time now, that utilizes that sort of scale in order to get efficiencies around the administration costs, for example. So there's different types of efficiencies, and there's different models that will focus on different aspects of scale and different aspects of efficiencies to make sure that you're getting a good deal for the member at the end of the day.
And again, you mentioned regulation there. Um, if not, perhaps maybe not asking you to wave your magic wand, but what kind of approach might you prefer from the regulator in terms of how they go about things? I mean, they could issue a blanket requirement for all these things, or would you prefer a more case by case approach whereby perhaps we see a regulator that's got a bit more discretion to pull levers to allow schemes to do different things should they meet certain requirements?
Yeah, absolutely. I think our preference would be around a business case approach to regulation. I think what that enables is, and I think discretion is an interesting one, but I think it's also about the ability to recognize different business models and how they operate. I think the challenge with a blanket rule, albeit totally acknowledged, it's probably where government's headed in a broad sense, but it's sort of a bit blind to the impact it has on business models and therefore different members who sit within different business models. And I think, what we often call for from a now pensions kind of perspective is a recognition by policymakers that there is a variety of not just product design, but business model. And where we've developed our business model has been particularly focused on lower earners and smaller employers and supporting those members and employers through the automatic enrolment process. But that does mean we're designed in a slightly different way to other providers. So if you had more of a business case approach, what you could do, for example, is you could look at the broader group structure to see if there's capability around private market investment rather than say our only indicator about your capability is the size of your assets under management. So it would enable that kind of much more bespoking, and you would get the same outcome for members because you'd still get the private market investment, but without the upheaval that would be created to members if, for example, we can't meet the assets under management figure, which I have every confidence we will. But it's kind of having that ability to be able to look at a particular scheme and say, so what is it offering? What is it delivering? Is it meeting the sort of intended outcome rather than just one of these very high level indicators? And I guess, the high level indicators could be valuable in indicating that it's worth more attention on certain schemes to kind of scrutinise and look at what they're delivering. I think, the other element of the business case regulation would be, one example of that would be on the timing requirement. So I think the consultation document set out achieving these things by 2030. I think that's quite a challenging timeline. But I think when you're looking at a growing market, bearing in mind it's sort of an evolving growing market, people saving into DC is relatively new in sort of in terms of decades, and there's more growth to come. There's a lot more growth to come. So looking at in terms of trajectory of development, I think would be really helpful. To have that harsh cutoff, I think it is quite challenging, and it could also lead to kind of perverse impacts on market development because you might have clients that look and think, oh, we don't think you're going to meet your assets under management thing and shop elsewhere without realizing what plans the scheme has in place to achieve that or how it's going to go about achieving that. So I think the blanket rule, it sort of has some really really impactful, are they side effects or are they intended effects? I'm not sure, but they have some really significant effects on competition in the market. So I think, yeah, a business case regulatory approach would just enable that greater scrutiny. I mean, we're not a massive landscape for these requirements because they're applying to multi-employer schemes and master trusts rather than single employer trusts. So it's not a huge market. So it kind of feels like a reasonable sort of challenge to make to government about could they consider that approach. But yeah, definitely think business. There's a lot to be said for business case regulation.
And to what extent does uncertainty around consolidation make it difficult for you to make long term investment decisions?
It could be. I guess the first thing to say is that our trustees are hugely skilled at making decisions about the long term with an element of uncertainty about the near term. That's sort of their area of expertise. And I have every confidence in them and trustees of Master Trust. I think the challenge, though, is around the specific and immediate term requirements that government's making around private markets. In terms of you don't, it's not something you want to undertake in the short term. And if you're thinking about consolidation and that you may need to be consolidated or you might need to be merging your fund, you're probably not wanting to make that jump necessarily. Also, these things are a long term in the planning, right? So there are measures and investments that are being made now that, if you knew your scheme was going to be taking a different direction 6 months ago, I think they're all interesting questions. But I guess the key thing will be to get this outcome from government in terms of what their conclusions are to pensions review part one. That will give us, and I'm sort of really hopeful we'll get that in the coming weeks. So that will give us a huge indication about direction of travel, which will be very welcome. Whatever it says, the clarity will be very welcome. And that gives us kind of a step forward. I mean, I guess stepping back strategically, have we faced these moments in the past where government's made a really big intervention in order to put the industry on the track it wants going forward? And yes, there's a few hiccups along the way in the short term, but they get ironed out over the long term. And remembering all the time that pensions are a long term investment, needing to make sure, I guess, that there's clarity for members approaching retirement in the meantime. But I think there's some challenges in there. I don't think they're necessarily insurmountable, but I think, you have this period of time where there's policy and development, you don't yet have the conclusion, but you can see big changes coming. And so there's sort of that appetite for wanting that clarity, I think, over that change. So I think apart from the short-term drive for private market investment, as well as the short-term drive for consolidation, that's a challenge. I think everything else, it is just that moment in time that's the challenge.
My next question concerns the apparent confusion that's continued, or at least it seems to me like a fly in the ointment when with consolidation, because we've still got the issue around contract-based members as well as trust-based, and how we're going to
Yes.
bring all these
Yeah.
together.
So yes, that's been an interesting evolution, hasn't it? The contract-based, trust-based world. And my mind wants to go back to the history of it, but that's not the point in hand at the moment. I think we've seen a movement to more people being in trust-based schemes, but predominantly that's because contract-based providers have built master trusts as well as having their contract-based business. I think there's measures in the consultation that we're anticipating will go ahead around the ability for contract based providers to transfer members without member consent, where they will be moving from a poorer performing offering into a better performing offering. And I think there'll be a number of appropriate consumer protections and guardrails and things like that that are put around it as well. I think it could see, I know this question came up in the panel at the time, and I think I said I wasn't sure that it would see a change. 5 minutes after answering that question, I thought, oh, maybe it will, because what you might have in the contract based provider environment is where they also have a master trust, is potentially, obviously, to look at whether or not they can move people from the contract based arrangement, not into another contract based arrangement, but into the master trust that that provider might also hold. I guess in terms of numbers, that means there might be more people in a trust based arrangement. I guess that trust based arrangement looks a little bit different to traditionally what a trust based arrangement has looked like. But yes, the numbers might shift. I think it will depend on what the details, again, it's another, what the details are from government in terms of what that power and what that override actually enables, and the way in which it enables it, and how comfortable providers feel about moving people around in that fashion. I think especially, I mean, it's not something we have concerns about at Now Pensions for our members, but I guess in other providers there will be some hard thinking around, if there is a move into private markets and people are in funds that aren't invested in private markets, they may well be cheaper than the fund which is offering private markets. And therefore, how does that override work? How do the protection work? What is that balance? And we all know that all of us want to be moving to an environment that puts value ahead of cost. So you would think in that environment that it would be possible to do that, should the forecasting be robust enough and sufficient enough to show that you'll get better returns, or indicate, should I say, indicate that you are much more likely to get better returns in a more expensive investment fund, then you would think that that contractual override should be allowed. But I think it's a big challenge for a provider to make that decision. So there's a lot to unpack in there in terms of the specific legal detail, and also how it will be conducted. So I know there'd been discussion in the consultation paper about whether IGC should be a body that's involved in overseeing these kind of things. So it'd be interesting to see where the government lands. I think the worst possible outcome is that something is allowed in law that isn't practically deliverable in practice. And so there'll need to be a lot of consultation over the protections for members and how that actually works in practice, I think.
This is where you can wave your magic wand. I'd like to get an idea of what you think an effective government roadmap might look like, given the caveats that we haven't had the consultation completed yet, and also that any of the reforms that we anticipated in that second phase appear to be put on the back burner. So,
Yeah.
what do you think that roadmap might look like? And as a second part, do you think we need to wait for dashboards to be able to push that ahead?
Yeah, no, it is really challenging to work out what an ideal roadmap would look like when you're sort of hedging your bets a bit in terms of where you think government might move first. And I think we have to acknowledge that the government focus and priority on growth means that they're going to push first on the private market and potentially consolidation as a means to achieve that. I think it's very hard from that point on because we don't know the details of what that looks like to think about the ordering of things that comes after it. I think with this question 6 months ago, before the consolidation consultation, I could have been a lot clearer. I think what I would be thinking about if I were in government shoes would be, where are you going to get the fastest change for this thing that's most important to you? And that's why I think they'll go private markets consolidation first. I think I'd then like to think they'll be thinking about the more direct impacts on the member, bearing in mind private market investment and consolidation. It's going to take quite a long time for those things to flow out to be beneficial to members. So where my head would go next would be what is most important to members. And I think the decumulation agenda is one of those things. So providing more support to members at decumulation. I think I we have some things we'd like to explore with government further in terms of the detail of their policy in that space. But I think something that means that members have more support at decumulation would be welcome earlier rather than later. But because of the consolidation regime, if that's looking to have fewer schemes by 2030, you don't want to build something now which members get transferred into that won't exist or that will undergo another transfer later. Because from a member point of view, yes, it's about the amount of money they get from their pension, but it's also about trust and confidence in the system. And because we know that members, particularly members with lower levels of pots or many multiple pots, aren't necessarily, they're not sort of necessarily going to be checking their pension every 5 minutes. They're not necessarily following financial services news. They might be concerned to find that their pot bounces around several times or moves once it's in retirement. So for that reason, I think it becomes difficult to do decumulation immediately before the consolidation agenda. I'd definitely be voting for the decumulation stuff to go much sooner. And I think the same applies for small pots. Again, it's something that impacts members. It's something that impacts business. It would be good to have all that tidied up. And we were quite hopeful after now pensions pushed really heavily for this to go back on the agenda back in 2019. It's great that we now have the prospects of it being in a bill with the model that we like, the multiple default consolidator. Again, details to be confirmed, and they're quite important details. But I don't see the consolidation agenda necessarily helping the small pots issue, because there are a small number of schemes where the small pots issue is most dominant, and they are not necessarily the schemes that would consolidate together. Albeit I don't have a crystal ball, but just in terms of how those schemes are set up and how they work and where they sit, I can't see all of those schemes coming together necessarily. Famous last words. So the small pots thing, I think, could go ahead without disruption, other than the element of there needing to be a small number of default consolidators. So presumably we're going to have to wait for the dust to settle on consolidation before that can go ahead in practical implementation terms. So it's not a massively clear answer, because the consolidation agenda has created some challenges in there. But I agree with you about the adequacy agenda and pension review part two, because all of this could also change the scale conversation, because some schemes will have much more increased elements of uptake and increased contributions coming in if contributions to automatic enrolment to go up. I mean, I do think that needs to be the roadmap we're most keen, well, we're keen on seeing this roadmap, the sequencing of the policies, but also the roadmap for the evolution of AE, because whilst it's difficult to make immediate increases because of other measures like the increase to employers' national insurance, we can see there's a really big need to think about impact on members, impact on employers. But we think the conversation must be had now. There is never going to be a good time to have the conversation. Let's go ahead and have it, but we don't have to implement all those things straight away. It's better to have the conversation, agree together, and I mean by that members, employers, industry, government, everybody together, and work out where that's going to go. And that could then help us plot out where we're going as a business for the next 5 to 10 years, as well as where savers are going with their adequacy. The dashboard is an interesting one. So I think given where we've got to with the pensions dashboard programme, the investment that's gone into that, I think we want to press ahead with that. We think it would be helpful for members. And I know that you're sort of mindful of the other options out there and what other providers are doing. What I would say is the dashboard infrastructure will be more comprehensive than what providers are able to do at the moment, simply because there's a legal requirement on schemes to provide that data through to that dashboard. I think there are a lot of helpful apps and a lot of helpful solutions that providers are putting in place, and indeed we are as well, which will help members find their lost pension pots or pension pots that are with other providers now. But it's not most of those solutions don't cover the whole of market in terms of the searches or showing the data. What the pension dashboard programme will provide is that legal requirement for schemes to provide that data back to the member, to do it in a standard format, to do it within a fixed amount of time, for those timings to be reported to the regulator. So I think there are still massive benefits in going ahead with the pensions dashboard programme, despite these other solutions coming into play. So I think there's space for both of them. And hey, sometimes it's good to have more than one thing going because it prompts innovation, it keeps the pace going, and it gives something to the members in the meantime so that they can get on and do that stuff, which is really important too. But I think the other element of the commercial dashboards that will plug into the dashboard infrastructure, I think that's what government has currently paused, and they want to go ahead with the money helper first. And I guess that means that they can monitor and see how members are interacting with that, and maybe put some more consumer protections around the commercial ones. So that kind of feels fairly sensible. But again, keen to see the timeline on that. So yeah, I'm not sure that particularly helps because it's caveated and it all depends on different things, how they pan out and how they impact each other. But it's pretty tricky at the moment. I know we're really excited to think that government will be putting together this sequencing. They've told us a couple of times that that's in the pipeline, that's coming along. So we're really hoping we get to engage on that and that they consult on it and that we can feed into it.
Lovely. Thank you very much. It's been lovely talking to you again today, Lizzy. Thank you very much for your time.
Cool.
Thank you, Lizzy. Now, that just leaves me to thank you for watching. If you liked it or found it useful, click the like button. If you didn't like it or didn't find it useful, click the dislike button. I don't mind which you do, but just let me know what you think. Subscribe if you want to see future editions of Future Proof. And if you've got a topic you'd like to see covered or somebody you'd like to see interviewed, let me know in the comments below. But until next time, goodbye.